Hello everyone, welcome to the video. In this video, we'll talk about what are the different investment options available in the market. Obviously, we don't like to keep our savings idle. We like to invest in our savings and with a perfect or with a maximum rate of return. So we'll see what are the different options we have and what are the different rate of return we can get in each investments. Also, we'll see in which options we can get a tax benefit and in which we do not. So let's get into the video.
As we speak types of financial investments, so there are two kind of financial investments, short term investment and long term investments. Let's talk about them in detail. So first one is the short term investment, which is your saving bank accounts. So it's like the first banking product people use. Everyone is aware of it, that we put the amount in the bank, and which gives us a low interest rate of 4% to 5% per annum. They are like a marginally better than the fixed deposit, but obviously this is the safest option we have, and everyone is aware about it. It's the most common option that people have. So it will give you a rate of return of 4%, 5%, 6% at maximum. The next one is the money market. So they're like a specified form of mutual funds that invest in extremely short-term fixed income instruments and thereby provide easy liquidity. So unlike most mutual funds, the money market funds are primarily towards protecting your capital and then aim to maximize your returns. So money market funds usually give better return than saving accounts but lower than the bank fixed deposit. So they'll give you a return which is lower than the fixed deposit but obviously greater than the bank accounts. It's like a kind of money market, it's like a kind of mutual fund, so which will like your the capital amount is protected. You'll get your capital amount, which and with your and they will try to maximize the returns. So there's like a no as such a percentage given here, but obviously a certain amount of percentage will be there, certain amount of return will be there. So this is also one of kind of money market which is like a variable. It's like the percentage will be flexible and depend on where you have invested. So it's like a mutual fund. It's a short term mutual fund investment option. Next one is the fixed deposit. So fixed deposit with banks, so they are also referred as a term deposit, or people usually call it FD. So the minimum investment period for bank FD is 30 days. Fixed deposit with banks are for investors with low risk and may be considered for 1 year, 2 year, 3 years, 5 years investment period. As normally and obviously the rate of interest on less than 6 months bank FD is likely to be lower than the money market fund return. So obviously it depends on the time of period you have invested. If you have invested for 6 months, the rate of return will be less. If you invested for 5 years, the rate of return will be more. So depend on the variation, depending on the time frame you have invested, there'll be a different rate of return of that. So this is like a kind of short term investment which is there and everybody is aware of it, and I think most of the people go through it because these are the safest option we have with the bank. Next one is the long term investment options like post office savings, public provident fund, company fixed deposit, bonds, and mutual funds. Let's see one by one. So, in post office savings, post office monthly income scheme, it's a low risk saving instrument which can be availed through any post office. It provides an interest rate of around 8% per annum, which is paid monthly. So the minimum amount which can be invested is rupees 1000, and additional investment can be done in multiples of 1000. So maximum amount which can be invested in a single account is 3 lakh, and if the account is jointly, you can invest till 6 lakh. So it has a maturity period of 6 years, and premature withdrawal is also permitted if deposit is more than 1 year old. A deduction of 5% is there from the principal amount if withdrawn prematurely. So this is about the post office savings. So it can be bought from any post office. It will give you a rate of return of around 8% per annum, plus it is a very low risk saving because post offices and all, it's all belongs to government authority. You can do it in a multiple of thousands, and it has a maturity period of 6 years, and if you withdraw before 6 years, there'll be a reduction of 5% from the principal amount. Now the next one is public provident fund. So a long term saving instrument with a maturity of 15 years and interest is 8% per annum, which will be compounded annually. A PPF account can be opened through a nationalized bank at any time during the year and is open all through the year for depositing money. Tax benefit can be availed for the amount invested, and interest accrued is tax free. Okay, so whatever the interest accrued, it will be tax free, and the tax benefit can be availed through this scheme. Okay, and there will be a maturity period of 15 years, and interest payable will be 8% per annum. So this is about the public provident fund. Next is the company fixed deposit. So these are like short term to medium term investments. So it varies from 6 months to 6 years, 5 years, 6 years. These are borrowings by companies at a fixed rate of interest, which is payable monthly, quarterly, semi-annually, or annually. They can also be cumulative fixed deposits where the entire principal along with the interest is paid at the end of loan period, and the rate of interest varies from 6 to 9% per annum for company FDs, and the interest received is after deduction of taxes. So in this company fixed deposit, the interest, whatever the interest you have, it will be applicable to tax, and you will get interest after deduction of taxes, and there will be variation of interest rate based on the amount of period you have invested. You can get about 6 to 9% rate of interest per annum in this. The next one is bonds. It's a fixed income debt instrument issued for a period of more than 1 year with the purpose of raising capital. The central or state government, corporation, and similar institutions sell bonds. A bond is generally a promise to repay the principal along with a fixed rate of interest on a specified date called the maturity date. So basically it is from the central authority, like it's from the government authority, central or state government. They used to sell bonds, and they have obviously you will not going to you'll not going to have losses on your principal amount. Your principal amount is same, plus there will be a fixed rate of interest that will be there, and it has a specific maturity date. On that date you will get your returns. So this is about the bonds. This is one of the safest option in the long term investments. Next one is the mutual funds. So these are the funds operated by an investment company which raises money from the public and invest in a group of assets. It can be shares, debentures, equity, etc. in accordance with the stated set of objectives. It is a substitute for those who are unable to invest directly in equities because of resources, time, or fear, anything. Benefits include professional money management, buying in small amounts and making a portfolio, and making a diversification of all the portfolios, and making a mutual fund, and invested in all those things. Mutual fund units are issued and redeemed by the fund management company, so based on the fund net asset value, which is determined at the end of the trading season. So net asset value is calculated as the value of all shares held by the fund minus expenses divided by the number of units issued. Mutual funds are usually long term investments vehicle. Through there are some categories which are small, like a money market or liquid funds, which are short term investments. So basically there's a management company which take care of the mutual funds. They'll invest in all the group of assets and make a portfolio and invest in whatever the mixture of returns you will get on your investments, and it all depend on the net asset value. So net asset value is basically the value of share held by the fund minus expenses divided by the number of units you have. Okay, so I have a different set of video on mutual funds, so you can go through them in detail and what are the different kind of mutual funds available in the market. So basically this is about the investment and the short term and long term investment. I hope the video is useful to you. If it is useful to you, please don't forget to subscribe the channel. Thank you.